What's up, everybody? Welcome back. Patrick here, and moving on with the leasing chapter, I now want to talk about something called timing differences. And what I mean by timing differences is that in reality, there's going to be a difference in the timing between the lease payments and the tax shield that you get from these lease payments. So far, we've been assuming that both of these things happen at the same time. So if you remember from the net advantage to leasing formula, what we were doing was we were taking the lease payments and then we were multiplying them by 1 minus t, taking the after-tax lease payments, because that tax portion, we can reduce our taxes by that amount. It's a tax shield. And because we were multiplying these, we were assuming that both of these happen at the same time. However, in reality, that doesn't happen usually. So for example, let's say that you own a gym and you are leasing out space in order to run that gym. So what's going to happen throughout the year? Let's say that this is 1 year, this is the beginning of the year, this is the end of the year. Well, you're going to be making rent payments, lease payments, in order to rent out the space to run your gym. And let's say that the lease payments are annual. Well, when are lease payments usually happening? When are rent payments usually happening? When you pay rent to a landlord? They're usually happening at the beginning of the period. And because we said these payments are annual, the lease payments are going to happen here at the beginning of each year at time 0. That's going to be a negative cash flow. So we're making the lease payments on this gym business at the beginning of each year. However, when do you file your taxes? You usually file your taxes at the end of the year. So because these lease payments are being made for business purposes, we can use them to reduce our taxes, and we would get a tax shield. However, this tax shield would happen at the end of the year. That would be a positive cash flow. It's reducing our taxes. And this tax shield is basically equal to the lease payment times the tax rate. The tax shield on any expense is always just equal to that expense times the tax rate. If you remember the CCA tax shield, it was just basically equal to the CCA, the depreciation expense, times the tax rate. So the lease payment is happening at the beginning of the year, but the tax shield is happening at the end of the year. And this is what I mean by the timing differences. So let's bring in some numbers to show you how it works. Let's say the lease payments that you're making on this gym space per year are $100,000. So you got to pay $100,000 at the beginning of each year. And the tax shield you'll get at the end of the year when you file your taxes, let's say your tax rate is 40%, it would be 100,000 times 40%, which is 40,000. And then if we go back to how we were doing things before, when we were assuming that the lease payments and the tax shield are happening at the same time, well, taking these numbers, plugging them into this formula, we would have 100,000 times 1 minus 0.4, which gives us 60,000. Which, if you notice, is the net between these two here. However, this 60,000 we would just put at one point on the timeline. The tax shield and the lease payments together at one point. In this case now, notice how they're separated at different points, and that's going to make a lot of differences in the calculation because the time value is going to be different. We have to incorporate time value. So these timing differences are definitely something to consider because that net advantage to leasing calculation is going to be a little different. Now, lots of courses, lots of professors, they may not expect this. They may just want you to keep the tax shield and the lease payments to be at the same time like this, which is a lot easier. However, some professors, some courses do expect you To know lease payments are happening at the beginning of each period, tax shield is happening at the end. So just know what your prof expects. Hello, sorry to interrupt the lecture. So I have this $25 Amazon gift card here that has not been used, and here is the claim code for it. So if one of you wants to use that, actually, I'm just realizing you can't really see that. Let me refocus the camera. Boom, right there. So let's see who's able to get that first, and now back to the lecture. So let's show how these timing differences work through an example. So let's say you can buy a machine for $3.2 million and it will depreciate straight line for 4 years to a salvage value of 0. Alternatively, you can lease the machine for $900,000 a year for 4 years. Lease payments are tax deductible and made at the beginning of each year. Tax rate is 40% and the discount rate is 7%. Should you lease or buy the machine? And then what is the break-even lease payment? Now, I have this question written out as part of a series of lecture notes. If you want to print those out, I'll leave a link in the description box. Also for this question, there's an Excel file that I made, and you could download that as well. And the Excel file is going to be pretty useful, especially for the second part of the question when we're solving for the break-even lease payment. You'll see when we're dealing with timing differences, solving for that break-even lease payment is not as smooth of a process as it was before. There's other things to incorporate, and I'll explain the Excel file while we go through the question. So the first part of the question, they're asking us, should we lease or buy the machine? And the way we've been doing that so far is we've been finding the net advantage to leasing. However, if you remember the net advantage to leasing, I gave out a big formula. With the timing differences, you don't want to use that formula anymore. However, you still want to keep the general part of it, which is basically the MPV of the leasing minus the MPV of the buying. If you remember from the overview video on the net advantage to leasing, I mentioned that it's equal to this, just very generally. So we want to bring this back here. So we're still going to be doing this. We're going to be finding the MPV of the leasing, subtracting the MPV of the buying, subtracting the cash flows, getting the incremental cash flows, then finding the net present value. If it's positive, we lease. If it's 0, we're indifferent. If it's less than 0, then we buy. So to do that, I'm going to start off by writing out the cash flows for both options, leasing and buying. Then we'll take the difference of the cash flows, then find that net advantage to leasing. So let's start off with the leasing cash flows. Now, the leasing cash flows usually are composed of two things. The actual lease payment. You know what? Let's just put payment here. And in the question, we're told that the payment is $900,000, and the lease payments are happening at the beginning of each year. So we would have negative $900,000 at time 0, negative $900,000 at time 1, negative $900,000 at time 2, and then at time 3. And notice that each of these are at the beginning of each year. So this $900,000 at the beginning of the first year, at the beginning of the second year. This one is at the beginning of the third year. This one is at the beginning of the fourth year. Now we're also told that these lease payments, if you read the question carefully, they're tax deductible. So there's going to be a tax shield as well. And certain questions might word it in a different way. Different textbooks word it in a different way. So I said tax deductible, but you might see things like a tax lease or a true tax lease. That basically means that the lease payments you can reduce on your taxes and you receive this tax shield. Now, because we're dealing with timing differences now, as I mentioned at the beginning of the video, you file your taxes at the end of each year. So the tax shield for this lease payment here, this $900,000 at the beginning of the first year, we would receive at the end of the first year. And the tax shield is equal to the lease payment times the tax rate. And the tax rate I gave you as 40%. So you would take that lease payment, multiply it by 40%, and you would get $360,000. And that's happening at the end of the first year. So the tax shield for the first year is going to be in time 1. So that's the timing difference. The lease payment is in time 0 at the beginning of the first year. The tax shield is at the end of the first year. And you would receive tax shields for the rest of these lease payments, and they would all be at the end of those respective years. So we would put a positive cash flow of $360,000 at the end of each of these 4 years. And that is it for all of the leasing cash flows. Just the payment and the tax shield, nothing else usually. So what about the buying cash flows? Well, if we buy the machine, we're told that the machine costs $3.2 million. And if we buy the machine, we would have to spend that money today. So that would be like our investment. Or another word you could put here is maybe capital expenditure. So the investment or the capital expenditure, if we buy the machine, it would be $3.2 million. That's a negative cash flow because we would be spending that money. And that would happen at time 0. So now that we have all of these, what we can do is we can net out the leasing cash flows. Let's put like a net amount over here. So times 0, if we net it out, negative 900,000. In time 1, if we net these two cash flows out, we would get negative 540,000. Same thing here. And then so on and so on, you get the rest of the cash flows. That year 4 cash flow is positive 360,000. So these cash flows here, this line represents the total net leasing cash flows. And if you notice, if you look at the Excel sheet that I provided, it's in this exact format. The lease payments and the tax rate, there's like input boxes on the side, and then it just fills this out automatically. So you can specify whatever the lease payments are, whatever the tax rate is, and it will fill it out automatically. In my Excel sheet, I just made it to year 4, but if you want, you can just extend the formulas if you get a question that's maybe like a 5-year, 6-year, or take out columns if it's something less than that. So that's it for leasing. Let's move on to the buying cash flows. Now, if we buy the machine, then we're going to have to spend money today to buy it, and we're told that the cost of it is $3.2 million. So that's like our investment, let's say. Another word here can maybe be like capital expenditure. So our investment in the machine, if we buy it, it would be a negative cash flow of $3.2 million. That's going to happen in time 0. Now we're also told if we buy the machine, we can depreciate it straight line for 4 years. So if we depreciate a straight line for 4 years, what's the depreciation expense going to be? Well, it's going to be that initial cost, $3.2 million, minus the salvage value, which we're told is 0, divided by the number of depreciation periods, the number of years. And that would give us $800,000. So at the end of each year, if we buy the machine, we get a tax shield. Because we can, since we're using this machine for business purposes, or we assume we do, we can take this depreciation and use it to reduce our tax payments. And our tax shield is going to be the depreciation times the tax rate times 0.4, which would give us $320,000. Now again, since we're filing the taxes at the end of the year, that positive 320,000 is going to happen at the end of each of the 4 years. So this would be positive 320,000. So this row here now, this new row is going to be, maybe make this a little bit more in line. So this new row is going to be the tax shield that we get from depreciating the asset, the machine, if we buy it. So 320,000 at the end of the first year, positive 320,000 at the end of the second year, and then so on and so on. And then the last thing to consider if we're buying the machine is the salvage value that we would get for the machine. And the salvage value, we're told, is just simply 0, so that cash flow in year 4 is going to be 0. So now what we can do, we have everything, is we can net out all of these cash flows for the buying portion and get the buying cash flows. So year 0, that's going to just net out to negative 3.2 million. This would be positive 320,000 in time 1. And then once you have the total leasing cash flows, which is this row, and then the total buying cash flows, which is this row, you want to take the leasing cash flows and then subtract the buying cash flows. Because if you remember, net advantage to leasing, NPV of leasing minus NPV of buying. But instead of calculating those NPVs separately, what you can do is you can just net out the cash flows first and then just make one NPV calculation. So if we take negative 900,000 and subtract negative 3.2 million, that would be like negative 900,000 plus 3.2 million. Those two negatives would turn into a positive, and we would end up getting positive 2.3 million. As an incremental cash flow when we take the leasing cash flows, subtract the buying cash flows. And then you want to do that for the rest. So for time 1, total leasing cash flow, negative 540,000 minus 320,000, that would give us minus 860,000. And then same thing here, this would be minus 860,000. In time 3 as well. And then time 4, 360,000 minus 320,000, that gives us positive 40,000. Right? So notice that we have a positive cash flow in time 0 and time 4, and then the rest are negative cash flows. And then at this point, you can just throw these cash flows in your calculator and then calculate the NPV. Now the discount rate that we're using, we're told that the discount rate is 7%. However, that's the pre-tax discount rate. If you remember, we have to take that cost of debt and then multiply it. We have to take the after-tax amount. So we would multiply that by 1 minus 0.4, and we would end up getting 4.2%. So we've got to take all these cash flows and discount them at 4.2% and get the NPV of that. So again, you can just use your financial calculator at this point. So you would put CF0, 2.3 million, CF1, CF2, CF3, CF4. You would put your I as 4.2%, and then you can calculate the NPV. Now notice that, again, this follows the Excel sheet that I gave, and in the Excel sheet, I actually take the present value of each of these cash flows separately, so there's like an extra line, then I net it out. But that final net advantage to leasing number you would get, it should be the same as the Excel sheet that I gave you, and if you just input these cash flows here in your financial calculator. And when you do the calculation in your financial calculator, you end up getting this amount here, negative $43,617.47. That's your net advantage to leasing. Notice how this is the same amount that I got with the Excel sheet as well. And because this amount is negative, whenever the net advantage to leasing is negative, then we know we should be buying the machine. So that's the answer to the first part of the question. So not too bad. It's just with these timing differences now, you have to do everything a little bit more manually. So I would recommend always making a chart like this, doing the leasing portion, doing the buying portion, net out those total cash flows, and then just throw those cash flows in your financial calculator and compute the NPV. Now, the second part of the question is a lot tougher. When they're asking for the break-even lease payments, it's basically trial and error, and it's actually why I included the Excel file. So what you want to do with the Excel file is those inputs that are on the side for the lease payment, you just want to try different lease payments until you get a NPV or a net advantage to leasing equal to 0 or something very, very close to 0. And that's pretty much the only way to do it. There is a manual way to do it, but it's pretty complex, and I highly doubt that your prof is going to expect you to know how to do that. If you are interested in knowing how to do it manually, then you can contact me and I can show you. But I highly doubt you'll have to know that. But you can ask your prof just in case. But yeah, for the break-even payment, you just basically want to use the Excel file and you want to input different lease payments. And you'll see that when you input different lease payments, this is going to change as well because the tax shield depends on the lease payment. So this is going to change. The buying is still going to be the same. All the buying cash flows will remain constant, but then these total cash flows will change, meaning that your NPV will change. And you basically want to input a lease payment that would make that NPV close to or equal to 0. And I actually did the process, and when I inputted different lease payments, I ended up getting this break-even lease payment here. Now, this is not part of the timeline. I just wrote it out here because I'm sort of running out of room on the whiteboard. So the break-even lease payment is $881,194.91. If you input that on the side, you'll notice that that NPV should be 0. Now, you don't want to take this in the Excel file. You don't want to take this and input it here because these are just formulas. You want to input on the side, and then you'll notice that the lease payments will change. So you only have to input it once. So again, the break-even lease payments, got to do it manually. And when you try different lease payments, trial and error, you end up with this lease payment getting an NPV of 0. Now, in the next video, I'm going to do the exact same question, but instead of straight line depreciation, we're now going to throw the machine into a CCA class. And if you remember from the first finance course, when there's a CCA rate involved, the depreciation changes every year. So the question gets even more complex. Not too bad. We just have to make a CCA chart, and then these numbers here are going to change. But because they're all going to be different, then a lot of these cash flows, all of the cash flows are going to be different. You're not going to get that same consistent 320,000, for example, in time 1, 2, 3, and 4. But anyways, we'll cover that in the next video.